We're diving into a really deep analysis report today. BURU Financials Update, Cash Injection versus Dilution.
A very complex situation.
It is. The report details BURU's $25 million financing, their pivot to a defense platform through acquisitions, and the truly massive dilution risk from the warrant packages.
And the command of the capital structure mechanics in here is excellent, a really strong foundation.
It really is. So let's talk about maximizing the impact of that data.
The analytical material contains significant financial depth, but the use of highly sensational framing devices introduces a potential conflict between the content's rigor and its reported tone.
Right. It's a conflict of perception, really. I mean, the core analysis is so solid. That breakdown of the 80 million shares at a 1-cent exercise price, that's vital stuff.
It is, but then you see these phrases, things like must watch or saved by the bell.
And it starts to feel more like rapid-fire market commentary, you know? It creates this sense of urgency that almost undermines the deep, authoritative work that the numbers are actually doing.
Exactly. That's the conflict. When you use that kind of hyperbole, you risk a reader subconsciously questioning the objectivity of the whole thing.
Even if the math is perfect.
Right, and with numbers like a potential 1,900% guaranteed profit on Tranche A, the numbers themselves provide all the drama you need. They're severe enough on their own.
So the suggestion here is to reorient the framing. Let the tone be more objectively serious, more curiosity-driven.
Let the numbers generate the urgency, not the headlines. It'll add so much more weight and credibility to the entire report.
And we can see that reflected in the structure right away.
Yeah, for a concrete example, let's just look at the Section 1 title. Right now, it's the hook, the headline numbers.
Which again suggests you're trying to persuade me to read on. Something like capital structure shock, immediate cash versus projected dilution would work better.
Totally different feel. It immediately sets the expectation that this is a systemic analysis of trade-offs, not just a news digest.
And that serious tone has to carry through all the way to the end. The conclusion right now is verdict, lotto ticket or investment.
Which is a very binary, speculative question.
It is. A much stronger approach would be a more nuanced, conditional assessment.
Maybe something like conditional assessment, path to de-risking the capital structure.
I like that a lot. It elevates the whole discussion from just guessing to actual strategic scenario planning. It frames the conclusion as a roadmap.
Which is what a high-level analysis should be.
And finally, that 10-10 risk rating. It's powerful, but it feels a little isolated.
Like an editorial judgment stuck on at the end? The fix is to define what drives that 10-10 rating?
Exactly. Link it explicitly to the structural mechanics, to the sheer velocity and volume pressure of those Tranche A warrants.
So you're not just saying this is risky. You're saying the warrant structure itself mandates this risk level until these specific volumes are cleared.
It transforms the rating from an opinion into a direct consequence of the capital structure.
And that idea of connective tissue, the data point to the strategic implication, that's a perfect lead-in to our next point.
It is, because the analysis clearly outlines the bull case, this big defense pivot with the acquisitions, and the clear bear case of massive dilution.
Right.
But it stops just short of fully synthesizing how that immediate, guaranteed dilution directly impacts the probability of success for that strategic shift.
This is probably the single biggest opportunity for sophistication in the whole report. You know, you've established the company is trying this incredibly complex transformation into a vertically integrated defense platform.
Using this cash injection.
But the risk analysis focuses almost entirely on the stock price ceiling, like the 25-cent resistance. It doesn't dig into the operational consequences of that price suppression.
That's the weakness. There's no explicit link showing how the constant, systematic selling pressure from those 80 million Tranche A warrants could actually destabilize the execution of the acquisitions.
Right. You've pointed out the financial symptom, price suppression, but we need to see the impact of that disease on the company's ability to operate.
Because integrating Techne in orbit isn't just paperwork. It takes management focus, it takes capital, it often takes equity for incentives.
And a stock that's pinned between, say, 15 and 20 cents because of guaranteed warrant dumps, that's a profoundly more challenging environment to operate in, infinitely more.
So our suggestion is to add an explicit section, model out the time horizon risk based on this dilution pressure.
Articulate how prolonged price suppression limits future access to capital, which they will almost certainly need.
And how that hampers the actual integration milestones, which need time and a stable market perception.
And we can get very concrete about how to do that.
First, quantify the impact. You have 80 million Tranche A shares. Estimate how many days of average trading volume that represents.
Use that number to illustrate the sheer scale of the selling wall that the company has to absorb.
While at the same time trying to integrate 3 new companies. It makes an abstract risk feel very, very tangible.
Then you can link the cash back to the operational side. Frame that $23 million in net cash as an integration buffer.
And then analyze how fast that buffer burns if the defense pivot gets delayed, which seems pretty likely under this kind of market duress.
It directly connects the dilution mechanics to their immediate liquidity and their operational runway. It's not just about share count anymore.
And here's an angle that often gets missed. You could explore the counter moves this forces the company to make.
You mean with things like retention packages for the acquired teams?
Exactly. How do you structure earnouts or incentives? A suppressed stock price makes using equity for that incredibly difficult.
Which means they might need more immediate cash payouts.
Which shortens that integration buffer's runway even further.
Showing that clear linkage that the financial structure dictates the operational difficulty. That's what elevates this from a great report to an indispensable one.
And thinking about those capital structure mechanics brings us right to the third major opportunity here. Specifically, how the technical resistance levels are defined.
The discussion of technical analysis regarding the 25-cent price ceiling is insightful, but it can be made so much more compelling by shifting the rationale from the lender's profit-taking potential to the guaranteed structural volume at that level.
Yes. Right now, the explanation for that resistance is tied to the 100 million shares in Tranche B warrants.
And the report says the lender may sell to lock in profits.
That phrase, may sell, introduces a layer of speculation that just isn't necessary. It focuses on the why, the profit motive, rather than the mathematical certainty of the structural overhang.
That's the core issue. That volume of shares is a structural fact. It doesn't matter if the lender is feeling greedy or needs the cash that day. It's a wall of supply, period.
So the suggestion is to reframe that 25-cent level. Don't call it a profit target. Call it the dilution overhang threshold.
I like that. Strengthen the analysis by focusing on what a breakout above 25 cents would actually signify.
It would signify that the market has successfully absorbed 100 million shares of dilution from Tranche B.
It becomes a quantifiable validation of belief in the pivot. It shifts the resistance from soft sentiment to hard physics.
So, to make that actionable, instead of saying the lender may sell, define that level as the point where the capital structure will automatically experience the second wave of significant systematic selling pressure.
The key word there is systematic.
Right. And then you need to quantify the share volume required to get past that level. Use the 100 million share figure.
Contextualize it. Compare the effort needed to break that wall to the effort needed to get past the next levels. Tranche C at 37 cents and D at 47.
It shows the reader layer by layer the scale of the challenge that's just baked into the structure.
And this is so vital because it ties the technicals directly to the strategic timeline. The analysis has to emphasize that reaching the 50-cent bull scenario isn't just about revenue growth in 2026.
It's also about the total clearance and absorption of these massive dilution thresholds.
The technical milestones have to be seen as prerequisites for the strategic success.
That's